In the fast-paced world of 24-hour news cycles, the most significant shifts in the global economy often happen quietly. They don't appear as breaking news alerts on your phone or trending topics on social media. Instead, they appear as dry statistics in monthly reports, numbers that, if you know how to read them, tell a story of a fundamental transformation in how the world views money. In October 2025, one such statistic was released by the People's Bank of China, PBOC. To the untrained eye, it was just another line item on a balance sheet. But to macroeconomists and geopolitical strategists, it was a thunderclap. The official value of China's gold reserves had hit $297.209 billion. To understand the magnitude of this number, we need context. Just 30 days prior, in September 2025, that figure stood at $283.291 billion. That represents a jump of nearly $14 billion in a single month. In the world of sovereign wealth and central banking, moves of this size are rare. They are deliberate. They are calculated. For years, Western analysts have been tracking Beijing's slow and steady accumulation of precious metals. Back in 2022, when the world was grappling with post-pandemic inflation and supply chain crises, China set an official target. They aimed to reach approximately 2,191.53 tons by 2024. At the time, many skeptics in Wall Street and London dismissed this as ambitious posturing. But as the calendar turned to 2025, the data became undeniable. Not only had Beijing met that target, they had surpassed it. And rather than slowing down after hitting their goal, they accelerated. The most aggressive signal came in May 2025, a month that will likely be studied by economic historians. In that singular month, data indicates the addition of 73.83 million troy ounces to the national stockpile. This massive influx of physical metal coincided, not coincidentally, with gold prices piercing through historical ceilings to peak at $3,500 per ounce. When a nation is willing to buy tens of millions of ounces at all-time high prices, it sends a very specific message. It tells us that they value the security of the metal more than the cost of acquiring it. This $297 billion figure is more than just a hoard of wealth. It is the financial equivalent of a Declaration of Independence. For decades, the global financial system has been unipolar, orbiting around the gravitational pull of the United States dollar. Nations held dollars because they had to buy oil, to settle trade, to stabilize their own currencies. But what we are witnessing in late 2025 is the concrete result of a strategy known as diversification. It is a polite, diplomatic term for a seismic shift. China is systematically reducing its reliance on the U.S. Treasury market and reallocating that capital into a neutral, borderless asset that no single government can print and no single government can sanction. The $297 billion signal is clear. The era of the single currency world is fading, and a new, multi-asset reality is being built, brick by gold brick. Why gold? In an age of digital currencies, high-frequency trading, and artificial intelligence, why is the world's second-largest economy pivoting back to a yellow metal that has been used for 5,000 years? To answer this, we must look at the price tag that shocked the retail markets in 2025. $3,500 per ounce. For the average consumer looking to buy a wedding ring or a commemorative coin, $3,500 feels expensive. It feels like a bubble. But from the perspective of a central bank, the price is relative. When China, or India, or Poland, or Singapore looks at gold at $3,500, they aren't looking at the price of the gold. They are looking at the purchasing power of the fiat currencies they hold. The rise to $3,500 is not necessarily a story of gold becoming more valuable. It is a story of paper currencies becoming less stable. The catalyst for this shift began years ago, but it accelerated dramatically following the geopolitical events of the early 2020s. When the G7 nations froze the foreign reserves of Russia in 2022, a psychological line was crossed in the global banking community. It demonstrated that sovereign reserves held in foreign currencies, like the dollar or the euro, were not truly owned by the nation holding them. They were effectively IOUs that could be canceled if political disagreements arose. For a superpower like China, this introduced an unacceptable level of risk. Beijing realized that if they kept their trillions of dollars in savings strictly in U.S. Treasury bonds, they were vulnerable to the same kind of asset seizure. Gold offers the solution to this counterparty risk. Gold stored in a vault in Shanghai or Beijing does not require the permission of the U.S. Federal Reserve to be sold. It does not run through the SWIFT payment system. It is, in financial terms, a bearer asset. Whoever holds it owns it. This is why the price point of $3,500 has not deterred purchasing. In fact, the rising price has validated the strategy. As inflation in Western economies remained sticky throughout 2024 and 2025, the real value of bond portfolios declined. Bonds pay a fixed interest rate, and if inflation eats that interest, the investor loses money in real terms. Gold, however, has historically acted as an inflation hedge. By moving billions from bonds into gold, China preserved the purchasing power of its reserves. The surge to $241.99 billion valuation in the spring of 2025 wasn't just expenditure, it was capital preservation. Furthermore, we must consider the industrial and technological demand. We often forget that gold is not just money. It is a critical component in electronics, aerospace, and high-end manufacturing. As China continues to position itself as the global leader in advanced technology, securing a physical supply of precious metals is a matter of national security, not just financial speculation. So, when you see gold trading at these historic highs, understand that it is being driven by a fear premium, not fear of the metal crashing, but fear of the alternatives failing. In the world of commodities analysis, there is a widely accepted theory known as the iceberg principle. It suggests that what we see in the official reports from the People's Bank of China is merely the tip of the iceberg, visible above the water, while the vast majority of the mass lies hidden beneath the surface. The official number, the $297.209 billion, is impressive. But many seasoned experts believe it is a conservative understatement of China's true holdings. To understand why, we have to look at the supply chain. China is the world's largest producer of gold. Mines in provinces like Shandong and Henan churn out hundreds of tons of yellow metal every single year. However, if you look at export data, you will find a curious anomaly. China exports almost zero gold. Virtually every ounce mined within Chinese borders stays within Chinese borders. Now add to this the import data. For the last decade, huge volumes of gold have flowed from refineries in Switzerland and vaults in London into Hong Kong and Shanghai. When you combine the domestic mining production, which is not always counted in central bank reserves, with the massive imports, the math suggests a stockpile significantly larger than 2,200 tons. Some estimates from reputable geopolitical think tanks suggest the real figure could be closer to 10,000 or even 20,000 tons. Why would Beijing underreport their holdings? Why not brag about their wealth? The answer lies in strategic patience. In the financial markets, if a whale, a massive buyer, reveals the true size of their position, the market moves against them. If China had announced 5 years ago, "We intend to buy 10,000 tons of gold," the price would have skyrocketed to $5,000 or $6,000 overnight, making it much more expensive for them to acquire the metal. By accumulating quietly, using sovereign wealth funds, state-owned commercial banks, and military agencies, China has been able to buy the dip, accumulating physical metal without triggering a premature panic in the currency markets. Additionally, holding off-book gold allows for strategic ambiguity. It keeps the West guessing. It serves as a shadow insurance policy. If a major currency crisis were to hit the yuan, Beijing could theoretically reveal these hidden reserves to instantly inject confidence into their currency. This shadow gold is dispersed throughout the Chinese economy. It's not just in the central bank. The government has actively encouraged its citizens to buy gold for years. In Shanghai, you can buy gold bars at the bank as easily as you can open a checking account. This means a significant portion of the nation's private wealth is also stored in physical metal, creating a decentralized buffer against economic instability. Whether the true number is the official $297 billion or double that, the trajectory is what matters most. The flow of gold is moving from west to east. The historical vaults of New York and London are seeing their influence wane, while the Shanghai Gold Exchange is becoming the new center of gravity for physical price discovery. We need to clarify a term that gets thrown around a lot: de-dollarization. In sensationalist media, this is often portrayed as a sudden event, a Tuesday morning where the dollar collapses and everyone starts using the yuan. That is not what is happening. What we are seeing is a slow, methodical process, much more like the erosion of a shoreline than a sudden earthquake. China's gold accumulation is the backbone of this process. For the last 50 years, the global trade system was built on the petrodollar. Countries needed dollars to buy energy. Therefore, they needed to sell goods to America to get those dollars. It was a closed loop that kept the US dollar in high demand. But China is building a new loop. They are strengthening trade ties with the Global South, nations in Africa, South America, the Middle East, and Southeast Asia. This bloc, often referred to as BRICS Plus, controls a massive portion of the world's natural resources: oil, gas, lithium, copper, and food. Beijing is pitching a new deal to these countries. Trade with us in local currencies. We will buy your oil in yuan. You can buy our manufacturing goods in yuan. However, there is a trust issue. Why would an oil exporter in the Middle East want to hold yuan instead of dollars? The dollar is liquid and open. The yuan is historically controlled and restricted. This is where the gold comes in. By building a massive, visible, and invisible gold reserve, China is trying to instill confidence in the yuan. They are signaling that their currency is not just paper backed by government decree, but is supported by a fortress of tangible assets. We are already seeing the fruits of this labor. In 2024 and 2025, we saw bilateral trade agreements where gold played a crucial settlement role. If a trade imbalance occurs between nations, gold can be used to settle the difference, bypassing the U.S. banking system entirely. The $297 billion reserve acts as a confidence anchor. It allows China to issue sovereign bonds that are more attractive to foreign investors. It provides leverage in trade negotiations. And most importantly, it acts as a shield. If another trade war erupts, or if tariffs are raised to 100%, China has the liquidity to support its economy without needing to beg for dollars in the international market. The diversification push is not an aggressive attack on the U.S., it is a defensive fortification of the Chinese economy. They are building a financial Great Wall, made of gold bars, to protect their internal markets from external shocks. It is easy to look at these charts and think this is a China story. But in a globalized economy, this is very much an American story and a European story. The actions of the People's Bank of China have direct consequences for the average citizen in the West. First, let's talk about interest rates and inflation. For decades, China recycled its trade surplus back into the United States. They sold us sneakers and phones, took the dollars, and used them to buy U.S. Treasury bonds. This massive buying pressure kept U.S. interest rates low, allowing for cheap mortgages and cheap government borrowing. If China is now using that surplus to buy gold instead of U.S. Treasuries, that buying pressure disappears. This means the U.S. government has to find new buyers for its debt, or it has to offer higher interest rates to attract investors. This is part of the reason why we have seen persistent volatility in the bond market through 2025. The structural demand for U.S. debt is softening at the exact moment the U.S. supply of debt is hitting record highs. Second, the price of gold itself acts as a barometer for global inflation. When China sucks massive amounts of physical supply off the market, 73 million ounces in a short period, It drives the price up for everyone. For Western investors, this has been a double-edged sword. On one hand, the cost of jewelry and electronics has risen. On the other hand, millions of Americans who hold gold in their retirement accounts or ETFs have seen significant gains. The wealth transfer is real. Third, we must consider the psychological impact on the dollar's status. The US dollar enjoys an exorbitant privilege. Because it is the world reserve currency, the US can run deficits that would bankrupt any other nation. If that status is slowly chipped away, if 10% or 15% of global trade moves away from the dollar and into gold-backed arrangements, the U.S. loses some of its ability to export inflation. This means that future stimulus packages in the U.S. might be more inflationary than before. It means the cost of imported goods at Walmart or Amazon could rise not because of supply chains, but because the dollar simply doesn't buy as much as it used to on the international stage. The $297 billion in Beijing's vaults is effectively a bet against the current monetary policy of the West. They are betting that the US and Europe will continue to print money to solve their problems, debasing their currencies. By holding the asset that cannot be printed, China positions itself to be the relative winner in a currency race to the bottom. So where does this leave us as we look toward 2026? The data from October 2025 is a wake-up call. It is confirmation that the trend of deglobalization and re-metallization is not a fad. It is a structural shift that will likely play out over the next decade. For the individual investor, the takeaway is not to panic, but to pay attention. The strategies that worked from 1990 to 2020, relying solely on a 60-40 portfolio of stocks and bonds, may need to be revisited in this new environment. The fact that the world's second-largest economy is aggressively diversifying into hard assets suggests that return of capital has become just as important as return on capital. In plain English, keeping what you have is now a priority over making a quick profit. We are entering a period of resource competition. It's not just gold, it's copper, it's silver, it's uranium, it's arable land. Nations are securing the physical inputs of the economy because they trust paper contracts less than they used to. China's $297 billion move serves as a validation for the precious metals sector. It proves that gold is not an archaic relic, as some economists famously called it, but rather a thoroughly modern financial tool for sovereign independence. However, investors should also be wary of FOMO, fear of missing out. Chasing a market after a massive run-up to $3,500 carries risks. Markets do not move in straight lines. There will be corrections, there will be pullbacks, but the long-term floor underneath the price has been raised because there is a buyer of last resort in the East with very deep pockets. In summary, the story of October 2025 is not just about gold. It is about the maturation of the global economy. We are moving from a unipolar world dominated by the West to a multipolar world where the East is asserting its financial sovereignty. The gold bars stacking up in the vaults of Shanghai are the foundation of this new era. As we move forward, watching the flows of metal will tell us more about the true state of geopolitical power than any political speech ever could. The window to understand this shift is open. The data is there. The question is, are you watching the signal, or are you distracted by the noise? Thank you for joining us for this deep dive into the shifting tectonic plates of the global economy. This is a story that is developing month by month, and we will continue to track the data from the PBOC, the Federal Reserve, and the global markets to keep you ahead of the curve. If you found this analysis valuable, if it helped you connect the dots between geopolitics and your wallet, please take a moment to subscribe to the channel. We rely on viewers like you to help us break through the algorithm and share this financial intelligence. And I want to hear from you in the comments section below. Here is my question for you today. Do you believe China's gold buying is purely a defensive move to protect their wealth? Or is it an offensive move to challenge the US dollar's dominance? There are valid arguments for both sides, and I want to know what you think. I'll be reading through the comments and replying to the best insights. Stay curious, stay informed, and we will see you in the next video.